Hello, it's Michael Hessian again with Private Banking Strategies, and I'm here to continue on my path exploring the book, How to Become Rich with the Secret That Banks Don't Want You to Know. This is the 6th section of the book entitled How to Make Money Spent Come Back, with a kind of a fun little quote from Vincent van Gogh. Normality is a paved road. It's comfortable to walk, but no flowers grow on it. I like that one too. So, okay, let's take a look. So the question is, can we take back control of our money? Can we duplicate what banks are doing? I talked in the last video about a little bit about how banks operate and how the money always comes back to them. Can we do the same thing? And the answer is actually yes, to a large degree. Today, the problem is that almost everything we know about money comes from banks. We're just not taught it in school, certainly. I can remember graduating from college back in the 80s and suddenly getting credit card offers in the mail. I had no clue what I was doing. I wasn't making any money, and suddenly I could get stuff and start going into debt. So part of the problem is just it's not taught. No one knows about it. A lot of people do not know about it. So, and it puts people in a cycle of indebtedness, and really difficult to accumulate wealth over time because of that cycle. And part of the solution goes to looking at how things were at one point, and how really important and useful information gets lost just due to human nature sometimes. These things they're forgotten about. And there's a tendency as humans to chase the next shiny object. And so we go back in time and you see that in the first half of last century and before then, many Americans' wealth resided in cash-rich whole life insurance contracts. The fact that these contracts were, and still are, they're not tied to the stock market at all. There's no exposure to the stock market directly. And there are great stories, you can look them up, of how important those contracts were in helping the country get out of the Great Depression. There are also great stories of people like early on with Walt Disney, J.C. Penney, people like that who had enough money in their cash reserves of their insurance policies that they were able to come out of that period of time and even sort of help out and keep people employed. There's some really cool stories about that. And more recently, Ray Kroc of McDonald's was able to tap into his policies to get that business started. And then more recently, the woman from Pampered Chef, Doris Christopher, back in the 80s, same kind of thing. So, and what happens over time is that with branch banking, more banks being able to expand, and also a lot of more of a move to stock market related types of vehicles, 401ks, mutual funds, things like that, and a lot of mutual insurance companies demutualizing and becoming what are called publicly traded companies. So there was just this trend into stock market related types of things, and it was just kind of forgotten about to a large degree for a lot of people. But they're still out there, and they're still being taken advantage of. In a future video, I'll talk a little bit about the degree to which large banks take advantage of this strategy and have a lot of their money tied up in these types of contracts. So they are still available to us. And some of the benefits are, as I said earlier, with the mutual insurance companies or mutual holding companies, they have no direct exposure to the stock market. So it doesn't matter what the stock market does. I know it's coming back now, but who knows what's going to happen in the future. They'll have to deal with that volatility. There are guarantees within these contracts that are very powerful and lead to a lot of peace of mind, and I can attest to that. And they're structured to allow for maximum cash value and access to cash whenever wanted or needed, tax advantaged, guaranteed growth of cash value within the policy, and tax-free access to that money. And privacy, these are private contracts with private companies, so they are not government programs. The problem with government programs is that they can be changed anytime. And that's happened at times, and there's no guarantee that that won't happen in the future. So, and this is another thing that not a lot of people are aware of. You may have heard of the DoddFrank Act, which was originally called the Wall Street Reform and Consumer Protection Act of 2010, which came out of the 2008 financial mess. And what it nominally said is that we won't have any more bailouts for banks if they get to the point where they're about to fail, of which many were close in 2008. I don't have the numbers in front of me. I'll probably share it in a future video. But there were a lot of them very close, and obviously we bailed them out. And instead, if something happens like that again, there will be a bail-in, where the government can go in and freeze a weak bank's assets, determine what kind of shape it's in, and do what they can to try to save it. And in Cyprus in 2013, this happened, where there was a bail-in. They froze the assets of these weaker banks, and a lot of people lost a good chunk of money, because they said, we're not going to lose these banks. If you have money on deposit, sorry, you're down the list. You have to wait your turn. And it also stipulates, and this is, a lot of people don't know this, that you are now an unsecured creditor to the bank when you have your money deposited into it. In essence, you don't really own it anymore. So if the bank fails, you have to get in line with everybody else and hope for the best. It's just something that people need to know if things get really bad. And we may have avoided a bit of who knows how this is going to play out over time with the current COVID-19 situation. So one of the best ways you can protect your money is to keep it out of centralized banking. Back in the Great Depression, cash values within those policies, as I mentioned, were not impacted by that. And these numbers are startling. 9,000 banks failed during the decade of the 1930s. Estimated that 4,000 failed in 1 year of 1933 alone. And that by 1933, just a few years into it, depositors saw $140 billion disappear through bank failures. That's a lot of money back then. And there's no guarantee that won't happen again. So we want to change the way you think about money and start thinking like an honest banker and managing your finances in a similar way that banks do, where it goes out and comes back to you. And you keep the interest for yourself rather than it going out and being lost forever to the banks and lending institutions. So that's it for this particular video. Until the next one. The next one's going to be fun, because I go through and show you how fractional reserve banking or factoring occurs with banks, and how they are able to take our deposits and put it to work for them. Okay, so next time. Thanks.